Okay, good morning. Happy Monday. The good news is you did well on the quiz. I'll hand it out at the end of class. The mean was 84, which is very good. Some of you did excellent, and those of you who had a lower number, it was actually a pretty easy quiz. So hopefully this will be a bit of a wake-up call because we only count 2 out of the 3. And some of this material will be on the midterm on the 24th. On Friday, somebody asked me about the index futures and how they work. So let me just take a few minutes and explain that, or try and explain that to you. There are a number of equity indices that are traded on the futures and options markets. And I've explained earlier that, of course, these are non-deliverables because the S&P 500 index doesn't exist. So you can't possibly deliver it. But it's a weighted average of stock prices, and there are a number of these indexes. And so the futures contract is written on that weighted index. And so settlement takes place at the value of the index in the delivery month. So if you are long, you don't stand for delivery, but you must reverse your position before the last trading day, and it's reversed at the price that's equal to the value of the index, the spot index that day, because today the March futures will differ from today's value of the spot S&P because the March future is a prediction of what the S&P will be in March. If you fail to liquidate, then the clearinghouse will close your position out for you at the prevailing spot S&P on the last trading day. So this is in the Wall Street Journal. This shows the S&P 500, which is a very popular one. I'm sure many of you realize that the stock market has been up recently. So if we go back to October, almost the beginning of this quarter, the S&P was trading around 1,000 on the December futures. Okay, so this is a December contract. It's now trading up at 1,040. And I printed off the contract specifications from the Chicago Mercantile Exchange, and you can do that if you're more interested in this index or if you're interested in trading it. It gives you all of the specifications. There are some daily limits on daily price moves and so on and so forth. But the most important thing to note, and it's shown in the Wall Street Journal, is the value. It's $250 times the price of the index, 250 times the index. So if if you had gone long on October 1st at 1,000 and now it's at 1040, that's a price change of 40 times $250, which is $10,000. So one contract has changed in value by $10,000 since October 1st. Obviously, if you were short, you'd be down 10,000. If you're long, you'd be up 10,000. Do you have other questions on how this works? Yes. Yeah, the question is, do you have to subscribe to the Wall Street Journal to get the online graphs? Yes, you do. And it comes with the subscription. But there are alternatives. You could go to the CME and find some historical prices as well. These just are a little more current, a little easier to read. So let's just look at one other one. So that's the S&P, which is a very popular one. And the margin requirements are quite high in StockTrack if you're trading one of these indexes. So it's not possible for you to trade too many. I think you can only trade a few. Here's the NASDAQ, which is a little more volatile. This is also the December contract. And we see the NASDAQ has risen 100 points from October 1st, from 1320 to approximately 1420. That's on the December contract. The cash price for the NASDAQ, no, I just don't see it here. I'm sorry. Anyway, the NASDAQ futures contract is $100 times the index, And so here it's risen 100, so again it's $10,000. I'll just note that in the Wall Street Journal, I don't know if you have that page handy or not, the Wall Street has a habit of leaving some decimal points off, in particular when it comes to the indexes. So just keep that in mind. Okay. If you look in the Wall Street Journal, the S&P index for December is 101960. So obviously that's 1019.60. They've left those decimals off. And for the NASDAQ, they reported as 133850. And again, there are 2 decimal places there. They do the same with Japanese yen. So if that's a point of confusion, just check the Wall Street and see what the spot NASDAQ is or the spot S&P is, and you know that the futures will not be too different from that, especially if you're looking at a December contract. Okay? Does that answer your questions on the index? So it's certainly a contract you should consider trading. There's plenty of news on the stock market. It's fun to try and anticipate where the market's going based on the economic news that's coming in. And there's lots of information on television or in on the web or in the Wall Street Journal. Speaking of the Wall Street Journal, today's headlines on the commodities section, I emailed it to you this morning. You haven't had time to look at it. The reason I've sent it to you is, A, to encourage you to consider some other contracts. The story deals with frozen concentrated orange juice, corn, and soybeans. And on Friday, the U.S. Department of Agriculture, USDA, released quarterly reports on these commodities, which is typical. The government collects supply and demand information and releases this information on a regular basis, let's say quarterly reports. Have any of you seen the movie Trading Places? One, two, few. Okay. Oh, great. It's a wonderful film. Dan Aykroyd and Eddie Murphy. It's a hilarious movie, and it's about futures trading. So it's fun to watch, especially if you know something about the markets. Basically, they try to corner the FCOJ, the frozen concentrated orange juice market, by obtaining the government reports before they're released. Because they're released under a great deal of secrecy. They release them after the market closes on Friday. And periodically, the market will be surprised by these reports. Because clearly the market is trying to assess the supply and demand information as well. We've discussed the fact that the markets disseminate information and discover prices. When we get into Chapter 5, we'll discuss this in a little more detail. But then the government comes out with a report, and once in a while the market's caught by surprise because the numbers differ from what the market was expecting. And that's exactly the point of this article. It seems like there was a surprise, a strong surprise in frozen concentrated orange juice. The government's projecting a larger crop than what the market was expecting, and the price was down 9%. I guess that was Friday or Monday. I'm not quite sure. Is anybody trading frozen concentrated orange juice? Are you long or short? You too? Short? Okay. Okay, well now you know why. You have to give Eddie Murphy a call and see what he knows about the market. Also, corn was down because the report was bullish. In other words, the government is saying there's going to be more corn around than what we thought. And soybeans were up. So there was one market where the government was saying, actually the soybean crop is a little bit less than what we thought. And in soybeans, major competitor is Brazil. The same is true in frozen concentrated orange juice. Now, who knows? They've released this bullish report on orange juice, but anything could still happen this winter because that market's very susceptible to a freeze in the month of January. Okay, so it's down. But maybe that's a buying opportunity. If you think there's a possibility of a freeze this winter, it'll send that market higher. Okay. Thought I had our PowerPoint open. There we go. Okay, I'm going to start on Chapter 3 today. I think we pretty much finished 2. I did discuss bond futures and euro-dollar futures. So a couple of those slides you have are slightly different than what I covered on the blackboard, but essentially the same material. So we now have covered the basics of what these markets are, what their history is. You have a broad idea of their importance in the economy and their global importance. And you have some idea of a handful of contracts, how they work. So now we'll step back, and in Chapter 3, we'll discuss pricing for storable contracts. A lot of the agricultural commodities, but this theory also applies to a lot of the financial commodities. You can store a treasury bond or a treasury note, so the theory also applies. And then in the next chapter, we'll talk about financials. I spend a little time in this chapter on non-storables, but most of the interesting theory deals with storables. And the purpose of covering this material is to try and explain intertemporal price relationships. In other words, if you look at the Wall Street Journal and you see the October price of corn is $3, and you see December is $3.20, and you see March is $3.40, and you see August is $3. Okay, what explains that set of prices across the different delivery months? As we look ahead through time, the set of intertemporal prices, what explains that? Is it different for storable versus non-storable? And is it different for financial versus non-financial? So that's really where we're going with the next set of lectures. So Chapter 3 starts out by discussing the importance of storage and how the role of storage links these markets. Obviously, if it's a storable commodity, for example, crude oil is storable, the price for March delivery should be related to the price for December delivery. If it's a non-storable, that linkage is broken. So there's a different explanation for those intertemporal prices. But let's just look at an example here. So this is what I call intertemporal commodity prices. So here's one example in soybeans and another example in wheat. First of all, we have a cash price. In soybeans, it's $5.05 a bushel. In wheat, it's $3.87 a bushel. So we use the terms cash and spot sort of interchangeably. They're very similar concept. And as you know, there are a number of different cash markets in the US and obviously around the world. But the futures market normally specifies delivery in just a handful of cash markets. For example, in the case of soybeans or wheat, the delivery is specified in Chicago or near Chicago on the river system. So when we refer to the cash price, we have to be very specific. Are we referring to the cash price for the same delivery location as specified in the futures contract? Because there's also a cash market for wheat in Stockton, and that price will be quite different from the cash price in Illinois on a given day. And the futures contract for wheat doesn't specify delivery in Stockton, it specifies delivery in Chicago. So as you might expect, as we enter a delivery month, the cash price for the deliverable positions, in other words, say the cash price for Illinois, and the futures price will come together because they're essentially becoming the same thing. In the month of December, whether you're talking a cash commodity in a warehouse in Chicago or a futures contract that specifies delivery in December in a warehouse in Chicago, we're talking the same physical location, the same time period approximately, so there's only a slight difference. But if we're referring to Stockton wheat in December and December futures, then you know that there are a lot of miles between Stockton and Chicago, so the prices are different. So I'm just giving you that background because we'll soon start discussing price differences between cash and futures or between different futures months. And another term for that is the basis, and that's something you'll become very familiar with when we get into hedging. The basis is the difference between the futures price and the cash price. We'll leave the definition at that for the time being. So we have our cash price, let's say in the case of soybeans, then we have our futures prices, and you see that the current cash is 505, the NOV futures 533, March 554, and so on. So what do you notice about those futures prices? As we move forward in time, what sort of relationship do you see there? Is there a trend in those prices? Going up, right? Why do you suppose the more distant contracts are priced higher than the nearby contracts? What's the difference between soybeans in November and soybeans in March? Storage, thank you. It's just time, right? Because we've got the Chicago cash here, so it's simply time. That's the only difference. Storage costs. Storage costs money. So if you hold the commodity between November and March, that's going to cost money. So if we look at the market today, and today the market says beans for immediate delivery are worth 505, for delivery in March are worth 554. That just reflects the fact that it costs money to store between now and March. And today that's the best predictor we have of March futures. Now tomorrow the information might change. Okay? The USDA came out with a report saying that the soybean crop is going to be less than we expected. So what happens? The cash price moves down. What do you suppose happens to these other prices? They all stay the same or go up or down? Or the news is bearish. The crop is larger than we expected. I guess it was the other way around in the journal. I'm sorry. Smaller than we expected. So it's bullish news. I better stick with the Wall Street. So it's bullish news. Spot price goes up 9 cents a bushel. What happens to the futures prices? They go up too. So the whole spectrum moves up. Thank you. So really, when we look at the set of intertemporal prices, we're just taking a snapshot in time. We're taking a picture of what the market is today. And today, based on our information, this is the spot price, and this is the set of intertemporal prices. And you can think of March as being a prediction of what the spot price will be in March. And a very crude estimate of that is to take today's spot price and add the cost of storage. And that'll get you very close. Okay? So the price difference between November and March is 21 cents a bushel. I would say, roughly speaking, the cost of storing soybeans from November to March will be 21 cents a bushel. Now, that spread will never become too much larger than the cost of storage. Suppose the cost of storage is 21 cents a bushel, for sake of argument, between November and March. If the March future went to 574 all of a sudden, so there was a 40-cent gap between those prices, what sort of arbitrage activity would kick in at that point? If March went to 574 and November didn't change, what would you do if you were a grain trader? Yeah, both answers are right. You would sell March. It went up to 574. You sell March and you'd store. So you'd buy November. So you buy November, take delivery, store it until March, and you've locked in 40 cents and it only cost you 20 cents. So there's a risk-free arbitrage profit there. So that activity that you just described will result in what price relationship between November and March? If everybody wants to buy NOV and sell March, what's going to happen to that 40-cent spread? It's going to come back down to roughly the cost of storage. So this arbitrage activity, which means you buy in one market and you sell in another to make a profit, will ensure that for a storable commodity, the set of intertemporal prices will really never exceed the full cost of storage, and we call that a full carrying charge market. Will really never exceed the full cost of storage. So arbitrage is a very important economic activity. Okay, when you go into the grocery store, when I get coffee every morning, I always arbitrage the line in the coffee house versus the line over there where they sell the breakfast. And I try to decide which line will move faster. When I go to the grocery store, I'm trying to decide which line to get in because I want to get in and out. So I'm arbitraging that opportunity. It's no different than these grain merchants buying in one market and selling in another. They're trying to make a profit. I'm trying to save time, so I'm not late for class, right? So the soybean market reflects what we would call a normal carrying charge market. That's the typical price relationship we would expect to see for a deliverable, storable commodity. The more distant the futures month, the higher the price. Now let's look at wheat over here. So do you notice anything different about wheat as we go forward? Prices drop. When we look at the cash is 387, D's 403, March 412. So that's a carrying charge relationship. And then it drops in September. Well, what do you suppose might happen between March and September? Harvest, thank you. So there's, likelihood, in the northern hemisphere at least, there's a harvest in here. So as we go from what's referred to as the old crop, which is October cash, December futures, March futures, that's the old crop, to the new crop, then we have an inverted market. So we don't have that positive carrying charge, it's actually negative. And so the market, again, is playing an important role here. We would see this sort of inversion or backwardation, if you like, whenever there's a small amount of stocks to be carried from old crop to new crop. There's a small amount of stocks. So the market is sending a signal to the owners of stocks. And what is that signal? In the case of soybeans, the market's paying a positive return for storage, right? In the case of wheat, if you bought March futures and sold September and expected to take delivery in March and then deliver in September, would that be a very profitable thing to do? No, that would be stupid, wouldn't it? So the market's sending a signal to dump your inventories. Don't carry them forward because there's a shortage, so let them go because it's not paying you a positive return to carry that forward. Now some companies, especially processors that actually use the material, will need to carry some forward. But they actually won't be paid for carrying it forward by the market because there is a shortage. So that's when we'd see backwardation or an inverted market. So that's a strong signal that before the next harvest, the level of inventories is going to be small. So here's a picture that shows much the same information. Okay? This is time on the horizontal axis. So we have August through July. We have price on the vertical axis. And we have the price for December futures, March futures, July futures. So here we have an example of where the spread between August spot and December is 20 cents, which accounts for storage costs. Between August spot and March is 35 cents, which reflects storage costs. And then we have a discount. So this would be like the wheat example, where there's a discount for the new crop because there's a harvest between March and July, and the market is not willing to pay merchants for carrying the inventory forward. So you see this type of relationship whenever there is a short-term shortage. You'll also see it in the crude oil market. It's not as though we have harvests of crude oil, but there are cycles, there are periods of excessive production and periods where production is slower. And as a result, there could be some temporary shortages even in the crude oil market or any other storable commodity for that reason. And if you see that, then you'll see the market go inverted. So one way to interpret this graph is today the cash price is $250, and as we move through time, so if you put that into storage, we would expect the price to rise because it costs money to store. You have the physical warehouse costs, you have interest costs, because if you own the physical commodity, then you have the opportunity cost of your money tied up in that inventory. So that's an important part of cost. So the interest rate, the physical storage costs, insurance costs, so it all adds up. And so you would expect that cash price to rise. So when I referred to today's set of prices as being a snapshot in time, this is really what I'm talking about. Today, this is what the market is reflecting with regard to the intrinsic value of this commodity, whatever it might be. It might be corn or wheat, any storable commodity. So this is what the market's reflecting. Tomorrow, we could receive some news that moves the market, just like we did in today's Wall Street Journal. And the whole spectrum could go down, or it could go up, but we more or less expect the spreads to stay the same. The price spread between cash and DEES, between December and March, and so on. The whole spectrum will move up and down as news comes into the marketplace. So today, the best forecast of the spot price in December is $2.70. That's the best forecast of what the price is going to be in December. The best forecast of what the price is going to be in March is $2.85. Of course, it could all change tomorrow. Okay. I just want to show you a little model that some of you might be familiar with. And the purpose here is to illustrate the fact that this economic activity that we call storage will link markets together that are separated by time. Okay, so I've explained that when you look at the spectrum of prices, they're all related because we have storage, and we all know that. And I've said that everything moves up and down together. But let's try to formalize that a little bit with a conceptual model. So this could be the price of any storable commodity. For example, it could be heating oil. Let's just take heating oil as an example. So we have two distinct time periods here. We have the summer period and the winter period. In the summer, the demand for heating oil is less than it is in the winter because a lot of the heating oil is used to provide heat for homes and businesses. So the demand in the summer is shifted left. The demand in the winter is shifted far to the right. In the absence of storage, we'd see some pretty major seasonal price swings for this commodity. If no one provided storage, and it goes back to our discussion of the history of futures trading, if no one provided storage of heating oil, then the price in the summer would be quite low and the price in the winter would be quite high. The only reason that the price of heating oil doesn't go through the roof in most winters is because inventories are carried forward from earlier months. Okay, you'll see those characters on late night TV, the infomercials, trying to talk you into buying heating oil futures because they argue every winter the price of heating oil rises. Well, that just isn't true because there's arbitrage in this market, and there are a lot of merchants who buy inventories, put them in storage, and they expect to earn a good return on their activity, which is providing storage. They just want to get paid for what they're doing, which is providing storage facilities. They want a return on their investment. But it doesn't matter, it doesn't mean that the price of heating oil doubles every winter. But in the absence of storage, you'd see some pretty wild price swings. Now, what ties these markets together is the fact that there is a demand and a supply for storage. And this is really important because one of the next topics we'll discuss is a very formal theory of the price of storage. This is a sort of an introduction. We'll go through a very formal, a very rigorous theory of the price of storage. So you can think of storage as just another market where there's demand and supply. There's demand for inventories because people want to buy heating oil in the winter. So they demand that the inventories be carried forward. There's supply of inventories because there are willing merchants that are prepared to carry the inventory. So it's just another market. So if we look at the summer period, at a price of 40 cents, the market clears. But if the price in the summer, for some reason, happened to be slightly higher than 40, let's say it was up here at 42, slightly higher than 40 cents, well, then supply is greater than demand at that price. So if the price were 42 cents in the summer, the market would not clear. If supply is greater than demand, then some of the production must be going into storage, correct? So at 42 cents, we're producing 1,000 units of heating oil. The demand is only 800 units, so there's 200 going into storage. As we raise the price in the summer, the volume going into inventories will be equal to the horizontal distance between supply and demand. And that's represented over here by this curve that I've labeled S sub I. So here you have the market for supply and demand. This is the inventory market. The intercept of the supply curve is where the market clears in the summer. Anything above that, if we go up to our 2 cents, well, that might represent the volume that goes into inventories. Okay? So this S sub I curve is derived from the supply and the demand in the summer. In fact, it's just the horizontal difference between the demand and supply. Then in the winter period, forget about the summer, let's just go to the winter. If there were no inventories carried into winter, the price would always be high, and let's suppose it would clear at 50 cents. So it would clear at 50 cents. However, it's reasonable to expect that given such wide price swings, merchants might be interested in storing. So if we lowered the price below 50 and we were down at this point, let's say at 48 cents, well, demand is greater than supply at 48 cents. We go down to 45 cents. Demand is greater than supply, and the volume between the two gets larger. Makes sense. As you lower the price, demand will rise, supply will fall. So the difference between the demand and the supply in the winter gives us the demand for inventories, which is over on the far right, D sub I. Okay. That's simply the horizontal difference between dW and SW. If we take dW minus SW, we get DI. Therefore, the intercept of that demand curve is where SW and dW cross, because the market clears at 50 cents. So at 50 cents a gallon for heating oil, there is no excess demand in the winter. If the price is at 48 cents, then there's this much excess demand, and we can find that spot over here on D sub I. So we trace out our D sub I curve, and that gives us the demand for inventories. Are you following me? This is, as I say, this model is a lot simpler than one we'll talk about on Wednesday or Friday. So if you're not following me, I'll be happy to cover this ground again. So the demand and supply of inventory has its origins in either excess supply. In the summer, there's excess supply as we get above 40 cents, or excess demand. In the winter, there's excess demand as we get below 50 cents. So that gives us our supply and demand for inventories, but we have to allow for storage costs, because the way I've drawn S sub I and D sub I, basically assuming it doesn't cost anything to store the commodity from one period to the next. Suppose the storage costs, okay, so we have a situation where without storage the price is 40 cents in the summer and 50 cents in the winter. Suppose the storage costs were 15 cents a gallon, 1.5. Do you expect there to be any storage? Would there be any storage? No, there wouldn't, because if you bought at 40 and stored it and then sold it at 50, you get a 10-cent return, but your storage costs are 15, so nobody would store. So we know that storage will only take place if the costs of storage are less than the price spread in the absence of storage. So here it's 10 cents a gallon. So if I shifted the supply curve up by 10 cents a gallon, then it would be up here somewhere, and there'd be no inventory carried forward. But let's suppose the storage costs are less than that, and so I'll shift this up by a few cents a gallon. So that shifts our supply curve up. Remember, the supply of inventories comes from here, and if we trace it out, we have S sub I, and we'll just shift it up by a fixed storage cost. We'll assume it's so many cents per unit. Okay? And it looks like I've shifted it up by 4 cents per unit. So I shift that up by 4 cents per unit, and now we have a market equilibrium for a storable commodity. We have our summer supply and demand haven't changed. The winter supply and demand have not changed. We've simply added this market for inventories, the supply and demand for inventories. Once we introduce that and allow for storage costs, then everything falls out in terms of our equilibrium. We have an inventory equal to 0Q5 that's carried from summer to winter, that quantity, and that will equal the distance between Q2 and Q1. It will also equal the distance between Q4 and Q3, because in the summer, the price rises because not only is there demand for use of the heating oil, but there's also demand for it to go into storage. So some folks are buying oil and putting it into storage. So that raises the price in the summer, and we see that the summer's price will be increased to 43 cents. So at 43 cents, supply exceeds demand, and that volume goes into storage. So this volume here goes into storage. In the winter time, the price is not 50 cents because not only do we have production of heating oil in the winter, but we also have this inventory, and they open their taps and sell it to the market in the winter time, which drives the price down, and so it falls down to 47 cents. At 47 cents, demand is greater than supply, but that's fine because the gap is made up by the volume of inventories. Exactly offsets the amount that went into storage. So a certain quantity went into storage, that was sold in the market in the next period. The prices came together as a result. They did not come completely together because the difference is equal to the cost of storage. If it's 4 cents a gallon, then the price in the summer is 43. The price in the winter is 47. The owners of the storage facilities are happy. They're getting a return in their investment. And we have a more efficient outcome where the seasonal price swings are less than what they would be in the absence of storage. And the markets are tied together. Clearly, if there's a supply shock in one market versus the other, then the market will move up or down together. And I can show you that with an example. So what's happened here is that there's been a supply shock, and it's still the summer period, but there's been a forecast of an unusually cold winter. Okay, so this happens, and we're already reading about the sort of winter we might have, and you'll notice this in the Wall Street Journal. And if you're trading the heating oil market at all, you'll see lots of news about what sort of winter we're in store for. So if you're interested in what the winter is going to be like just for skiing purposes or some other reason, watch the heating oil market. That's probably the best predictor there is of what sort of winter we're in for. It really is. Because it will react to this information. So if there's a forecast of a cold winter, then clearly the demand for heating oil in the winter will shift to the right. Because we're going to have to run those furnaces longer, and we're going to have to get ourselves through the winter. So the demand up here is going to shift to the right. The supply and demand is the same in the summer. The winter supply we're holding the same. So the net result is that this d sub I will shift upward, because remember, d sub I had its origins in SW and DW. It was just the difference between, it was DW minus SW. Right? DW minus SW gives you DI. And now we've shifted DW up. And so the intercept goes up, and we're on that dashed line, DIC. And we now have a new equilibrium between the supply, including storage costs, and DIC. And that raises the price in the winter to 49 cents, and it pulls the price up in the summer to 45. Right? So the difference is still 4 cents a gallon. But that simple forecast brought the price up today. So today's, you could think of the summer as the spot market today. It brought today's price up. It pushed up the forward price, the forecast for the winter price by the same amount, and the spread stayed the same, which was equal to the storage costs. And this is a very simple, but conceptually it represents what we see in any of these markets. There is a very active heating oil futures market. And this really explains how prices might change from day to day. So if somebody does come out and forecast a cold winter, the price of the heating oil you're paying for right now, even though we're not into the winter months, will also rise. Why is that? Because there's more going into inventory. They're taking it off the market today, and that's driving the price up. Okay, do you understand more or less this diagram? If you don't, I'd be happy to go over it again. Have you seen this sort of model before? It's a model you might run into in some of your other classes. Anybody seen it before? Nobody? Yes? What sort of class is it? What is that? Macro? It's just a model where we're linking two different time periods. And the linkage is the supply and demand for inventories.
You're saying that like storage only takes place if the absence of storage costs what allows for the market to clear?
Can you repeat that? I don't think that's quite what I said, but.
No, that's not.
Oh, okay. Sure.
What is the storage? Storage will take place if the absence of storage is what?
Okay, storage will take place if the cost of storage is less than the difference in price between the summer and winter, in our example, in the absence of storage. So let's suppose that storage costs were 4 cents a gallon, and in the absence of storage, the price spread is only 2 cents. Well, it doesn't pay to store, right? So no one will come in and start storing it. If the spread were at 4 cents, you'd have some folks providing storage. If it's 5, then more folks would come in and it would be brought back to 4. So in our case, we started out with a spread of 10. Storage costs were 4. It brought the spread down to 4. Suppose originally the gap was 20 and storage costs were 4. Then the introduction of storage would bring the price spread down to what? 4. That's the cost of storage. So in a competitive market, the price spread will reflect full cost of storage. I started with a price difference of 10. If it was 20, we'd get the same end result. The spread would be brought down to 4. If storage costs go up for some reason, if interest rates rise, storage costs go from 4 to 5, then that spread is going to change from 4 to 5. Is that cleared up for you? Okay. Any other questions? Do you understand where SI and DI come from? Mary? Okay. See, somebody's honest in this crowd. Okay, over here, we have DS and SS. So that stands for summer, right? And we'd have this equilibrium right here. What did I call it? I forget what number I had. 40 cents. 40 cents a gallon. If there's no storage activity. But there's a concept called excess supply. And we'll denote that by the summer period, ES, is equal to SS minus DS. And this excess supply refers to the fact that if the price rose above this market clearing level, let's say it was up here at 43 cents. If the price was above the market clearing level, then the amount supplied, right, we'll call this, I forget what I called it, Q2, very original, okay? And the amount demanded is Q1. Well, the market's not clearing, is it? The market doesn't clear at 43 cents. It clears at 40 cents. So it does not clear at 43 cents. So if that's the case, and here we have the market for inventory. Again, we have price and quantity. So we know it clears at 40. So we'll draw the intercept at 40 cents. As the price rises above 40, then we have an excess supply. And this distance here, I'll call this Q3, OQ3. So OQ3 will equal OQ2 minus OQ1. This distance is equal to this distance. Because the market doesn't clear above 40 cents, so there will be this excess supply. Supply is greater than demand. That excess supply goes into inventory. Does that help, Mary, with that one? Okay. And then likewise, in the winter, right, we have a much higher equilibrium. It's way up here somewhere, right? This is supply in the winter, demand in the winter. The market clears at 50 cents, but does it clear at 45 cents? No. At 45 cents, demand exceeds supply. If demand exceeds supply, it could possibly be serviced by inventories. So it clears at 50 cents. Anything below 50, we have an excess demand in the winter. And ED winter equals DW minus SW. So and so on. As we drop the price, demand exceeds supply. The gap widens. And so we have a greater volume of excess demand as we lower the price. Does that help? Okay, see you Wednesday. Oh, I need to pass out the quiz. Thank you. You know what?